What opportunities we have here going into our afternoon and into the end of this week. We're looking at the Fed Fund futures. We have 20 days until the next FOMC meeting, and currently there's a 49.9% probability for a hike at the September meeting. You'll also notice that those rate hike probabilities that were being priced into March have been pushed out to April of 2027. But it is tied there. It's 33.3, or excuse me, 33.0 and 33.0. So we're very close to flipping back and forth here between April and March of 2027. And then there's quite a large jump of 2% to get to the January 2027 FOMC statement for the second rate hike. Yesterday, there was an FOMC meeting minutes. And in the meeting minutes, there were three things that the Federal Reserve highlighted to creating inflation. One were tariffs, two were the conflicts in the Middle East, and then three, which was something new, and in the same sentence, was AI. The AI build out was creating inflation. And here's where things really get interesting, because what the Federal Reserve essentially did is they put in writing that the AI build out was essentially conflicting with the Federal Reserve's policy. And so what that means is that every time there's a CapEx announcement, anytime there's a new data center that is announced, anytime there's a new purchase of hardware by the hyperscalers, the Amazons, the Microsofts, the Googles, the Meta, the Oracles of the world, that is now in conflict with the Federal Reserve going back to or just staying neutral. And right now, also in those meetings minutes, there are more details about the members and how they perceived the neutral rate. Half of them essentially said that we're in neutral. The other half said we need to hike rates just to get to neutral, not even to be restrictive. And so what that ends up creating is an environment that good news is considered bad. You know, the AI story was just automatically bullish, coming out of these lows. And we, of course, have had incredibly bullish price action since those April lows, which, by the way, were a profit target. But since then, we've been going straight sideways since the beginning of June. And we're running right at 60 days here of just kind of going sideways up here. Now, we did run into the VIX's line in the sand of a short setup coming out of yesterday's price action. And those downside profit targets are actually confirmed here by breaking through the long from lows of the week to highs of the week. You can see this a little bit more clearly here when you're looking at a 4-hour chart. This was the previous low. These 1775s were the line in the sand for the long from lows of the week to highs of the week. That break of a 61.8% line puts us in a situation here, and there are two opposing setups. There are absolutely still two opposing setups, but it creates an environment where the VIX has confirmed essentially a target down here of the 1650, hasn't it? Breaking through the long from lows of the week to highs of the week confirms that short setup that we double topped inside of yesterday. And there also is a potential VIX short setup from yesterday's highs to lows. This also validates the potential here for longs from lows on the indices yesterday to our most recent highs. So unless we fall back down, this stream continues at eminiaddict.com. The link is in the description. Join me there for tools and resources for learning measured move trading. I wrote the book on the measured move. Check out the hundreds of others that have learned trading plan development, pattern recognition, money management, and trading discipline with me to become the best, most confident trader that you can be.